All right, thank you guys all for joining me on a Friday here. I know it's after the market. People are probably trying to rush to get off for their weekend plans. We used to say Fridays in the summer we would rush to the Hamptons, and that's when the markets would really slow down. I don't know if there was much of a rush for the Hamptons today with the market sell-off that we saw, but at the end of the day, there usually seems to be a little bit lighter volume on Fridays, and people cut out early. So I appreciate you guys sticking around. And this is going to be a strategy for a bullish to market assumption. But a few things get out of the way real quick. My name is Eric Wilkinson. Some of you may recognize me from CNBC, Fox Business, the Wall Street Journal, for my commentary on everything from economic to geopolitical and market analysis. I've been trading my own money for well over 20 years. I actually started trading in college with some money I had earned and actually investing, and then later on in my college career started selling calls against some of those portfolio products that I had. And I really didn't know a whole lot what I was doing. I started out with a psychology degree and went into finance shortly after starting to trade. But that's how I really got started. And then I moved to the Chicago Board of Trade, and I started trading my own money ever since. And I'm not here to tell you that I'm going to make you rich or that I'm going to make you a millionaire, but I am here to help you take control of your finances, manage your own portfolio, and most importantly, take control of your own risk. Like I started, like you guys are starting, or most of you are probably starting. Once you take control of your own finances, for one, you're financially independent, but two, you're not paying all these exorbitant fees. Even if you're doing a no-load fund, there's embedded fees in there that are really eating away at your yield. And yes, you are going to make mistakes in trading and investing, but you're not really going to, at the end of the day, make any more mistakes than what your financial advisors are already doing. So take control of that. You can easily do it yourself. Anyway, I've traded most markets throughout my career, even from the Chicago Board of Trade. I've traded everything from stocks, financial futures, commodity futures, and currencies, and options on all of these products in all market conditions. As you can see here, that was a crazy day. Anyway, any opinions, news, research, analysis, or other information provided here or provided by Pro Trader Strategies and or associate companies or employees is provided as general commentary and does not constitute investment advice or solicitation to buy or sell any of these securities or strategies we're talking about. One other thing, in full disclosure, some of these products I will have in my portfolio, and I'm not trying to get you to limbing off the cliff with me. I'm just telling you what I see in the market as value or something to implement into my portfolio. If you guys want to do that, that is on your own accord. And the reason why I can't tell you specifically what stock or strategy you should implement into your portfolio, it's because I don't know your risk parameters and I don't know what's already in your portfolio. So what I'm doing could quite possibly be counterintuitive to what you are doing. So you have to look at this, know what your risk parameters are before you implement any of these types of strategies or securities. And the bottom line is, do your own homework. Remember, past performance of any trading system or methodology is not necessarily indicative of future results. All right, so this is going to be on call calendars, this particular webinar, and it could be called a long horizontal spread also. A vertical spread is within the same expiration cycle, so you're going from one strike to another. This is going to be at the same strike but across a different expiration, which gives it that horizontal spread look. And we're going to be selling an at the money or out of the money call in the nearest expiration cycle, and the nearest being the nearest to 35 days to expiration. And then we're going to be buying the next cycle out. Then it's not necessarily a weekly, although that can be done, but I like to go for the full monthlies. And for the next full monthly, it's going to be about 75 days as of today. But if we're selling it at the money, we're going to be buying that same at the money further expiration or out of the money, we're going to be buying that same strike that's out of the money here. All right, so what we're looking for in a directional assumption. So we don't want to do something like, we wouldn't want to necessarily buy oil if we're bearish oil, okay? We wouldn't want to implement this strategy with crude oil if we're bearish at long term. You know, maybe if you're bearish near term and then long term bullish, that would be a different situation. You know, if you're bullish in the next few months, but you think there's going to be a bit of a pullback now, then that would be okay. And we want this to have low implied volatility percent. That means the volatility is low in percentage points as to what it has been in the past on itself. So we want this low implied volatility percent because when we get that expansion in volatility affects the further duration products more than it does the nearer term. So as volatility expands, it really affects those ones that we will be long. So in that, we want to see those premiums go up in the longer term faster than our nearer term. And we want high open interest in the options that we're doing. We don't want to be doing this in something, Trevor, I'll answer that in just a second. We want high open interest in these options because, you know, the further out in time you go, the less participation there is. So right now, the July options have probably the most participation. The further out you go to the August, those are going to have a little less participation, and those bid asks are going to get a little bit wider. And I always talk about it. You want high open interest in that options contract, because if you have to give up a nickel or a dime to get in and a nickel or a dime to get out, or, you know, 20 cents, 25 cents, that really eats into your profitability. It makes it very difficult to get out and be profitable sometimes. Plus, you're giving up a lot of your margin in that regard. Trevor's asking, how do you decide which to buy, at the money or out of the money? And that's a great question. I was gonna go over it in the a little bit later, but we can touch on it right now. It depends on how bullish I am in the near term. So for instance, if I'm really bullish, like, hey, this could start creeping up rather quickly, then I'm going to be buying the one that's just slightly out of the money or further out of the money. If I am near term, like the example of crude oil, if I'm near term, let's say crude oil now, like I think there's going to be a pullback and then a rally, you know, maybe in August or something like that, then I would be doing the at the monies. Does that answer the question for everybody? Because great question, and I implore you guys to ask your questions, because there's somebody else out there that is likely to have that same question. So if I've skipped over something or breezed over something, I want to make sure that everybody is clear on that. So the more bullish I am, I'm out of the money. If I'm like, you know, not as bullish in the near term, then I'll go towards the at the monies. Excuse me. So we want the correct directional assumption, obviously. This, because we're paying a debit, we want our directional assumption to come to fruition. We want this to be a trending up market, if you will. So we want just like a slow and steady rise, not something like that's going to gap up or gap down like we see in maybe Amazon or in Tesla and things of that nature. Those are the ones I want to kind of stay away from, because they can have really big moves overnight, and that can really hurt us. Yeah, Neil, high open interest. When we get into the platform, I will go over what is high open interest, and I'll show you how you can tell. Usually when you have high open interest, you don't even have to really go to the tab that says volume and open interest. You can tell by the bid ask. And one thing I say is we're going to be looking at stocks, you know, if they're less than $100, that needs to be within 10 cents of the bid ask, meaning if it's 90 cents bid at 120, then I'm going to skip that because that's like 30 cents wide. And that's what I'm talking about, that getting in and getting out is going to cost us a lot of money. So if it's $100 or less, I want it to be inside of 10 cents. If it goes up to like $200, $200 to 100, you know, I want it to be less than, say, 15, and in some instances, I'll let it go out to about 20 cents. But I would probably really want to get into that underlying for my assumption. I'll give up a little bit of that. But for the most part, I just look for opportunities and take advantage of it, and therefore I need it to be pretty tight bid-ask. And then we want volatility expand. I touched on that. We want the volatility to expand after we put this on. Since we're kind of winding down to the end of the earnings season here, we're going to see some of these long calls that we're buying in the longer expiration have more volatility in them because there's an earnings cycle built, or an earnings event happening, or a binary event happening in that option. So heading into that, that will be good for us to see that volatility expand the closer we get to that event. And we want to be able to cover this before that binary event, that said binary event, because at the end of the day, if we're profitable on this, why go into the binary event and risk our money? I mean, I'm the one that talks about probabilities and things of that nature. I'm not here to gamble. I'm here to play the probabilities out and take what's given to me. I'm not going to try and be a hero. One thing, you know, a lot of people will try and ride this out. The only time I will ride this out into that binary event is if I am carrying a loser. This trades against me. The market's below my long call by maybe $5, and I'm heading into a binary event. At that point, I look at it like, you know what, it's the roll of the dice now. I'm going to take that chance that I'm going to get my free shot at making this into a winning trade. Because remember, we've done this for a debit already. That's the most we can lose. So if we're wrong, we're only going to lose that premium. But if I'm losing on this trade heading into that binary event, if that happens, that's the time where I'm going to ride that out. All right, so our max profit is unlimited on this. And the reason why it's unlimited is because, you know, XYZ can go to infinity, they say. The likelihood of that happening in the next 70 days is not really going to be likely, but it will say it's unlimited. Our profit is, on this particular strategy, because you're doing it as a debit spread, those are the strategies. Anytime you're doing a debit spread, your probabilities are already against you. So in that, as soon as I'm making money, I'm going to be quick to cover this for any profit, you know, any decent profit, you know, maybe like $1 or something like that. So I'm not going to try and be a hero, go for the big money and, you know, ride this out, you know, it's a winning trade and ride this into the binary event to try and make some more money. I'm the guy that's going to tell you that what I would do. I can't tell you what I think you should do, but what I would do is take my money off the table. It's kind of like if you see this Texas Hold'ems or anything like that, and the guy's got aces, you know, pocket aces, and the other guy's looking at maybe, you know, a 8-9 suited on his side. You know, at the end of the day, you're thinking, well, if you wait for the turn, that guy could get us straight, you know, and your aces are worthless. So I look at it like, hey, I'm trying to play these two aces and not give that guy the opportunity to go in. So take that money off the table as quickly as you can. I don't know if that was the best example, but that's the one that just came to my mind. So manage these for small profits. Take your money. Isn't the max profit only after the short call has expired? Yes, John, that is. And that's what I should have probably made that a little bit more clear. It is only after that you let that front one expire, worthless, and then let the other one ride out. Great question, though. And your max loss is the premium you paid. So we're going to try and finance some of that value of the put or the call we're buying in that long duration month. So whatever we have paid at the initiation of this trade is the most we can lose on that. So that's why I'm talking about if you're let that front one expire worthless and this trade's gone against you and we're heading into a binary event, that's probably the time that I'm going to let this one ride through that event. Otherwise, I'm going to try and cover it for a small profit. And the break even is a long option, which is that longer duration, plus the premium we paid. So if we're doing it at the 70 call and we paid $1.50, our break even is when that underlying is trading at $71.50. All right, so let me pull up the trading platform and we'll get, oh, so it came up on the wrong side. Let me get it onto the other. All right, everybody can see that, right? Okay, so this is usually around the time that I throw it out to you guys. Let's open it up and in the questions box, throw out some ideas, because I like to go, I mean, I have some ideas that I've looked at that I think look pretty good for this strategy or something that I would want to implement, but I'd love to go through your ideas and that way we can walk through all the steps and I don't miss anything because I've gone through and vetted a few of them and I might miss something, so I like to go through the start. So Sophie's going with Facebook off the bat, so let's look at Facebook. And this is what I'm talking about, 35 days to expiration. The reason why is, and I've shown this a lot, one thing real quick, this is the theoretical options prices versus times, which is basically your theta decay. And from 35 days in, I usually like to go around 45 days on when I'm selling options, but 35 days is optimal because you get this 50%, you get this massive slope down in theta decay, which means that front is going to decay much quicker than this back one. So that's something that helps this strategy as well. Another thing that I look for in this strategy is I really don't care if there's a binary event landing inside of that long call area, but one thing I don't really want to see is I don't want to see a massive difference between these two options. This is the volatility of this one and this is the volatility of this one. Sometimes you'll get this as like a 10 point difference and you really want to stay within 5. The reason why I say 5 for this particular strategy is a lot of times you are going to have a binary event in one of these further duration options. So on this one, I don't mind seeing that because the closer we get to that binary event, as you can see here, that's not a very good example, but coming through into this binary event, which is the earnings, you can see volatility is ramping up. So we're implementing it back here and we want to see that volatility go up heading into that, kind of like here, you know, after the binary event, it's done, starts ramping up and going further. There was the earnings and the dividends, but as you can see, it ramps up heading into that, and then right at the binary event, it gets usually to its highest. Didn't do that so much here, but on this particular one, but that's usually what you're going to see in something like this. So Sophie threw out Facebook. You guys go ahead and go to the questions box and throw out some examples. So for instance, this one kind of ramped up. It did come off. I don't know what happened in there, but came off a little bit. The August obviously is an outlier, but here's a good example of how, you know, a month or so it consistently rallied up into the earnings there. So that's what we want to see. We want to be able to cover it before the earnings and have our market kind of rally off after that short call has expired, and then try and cover it. Or, you know, if it happens rather quickly where you are up maybe $1 on one of these, that's probably where I'm looking to cover it. All right, so right now, as you can see with Facebook is a good example. It's got really low implied volatility. And remember, Sophie, we must have the idea that we are bullish in this. It's had a nice come off there. Hopefully it would correct a little bit more just to allow our front month to expire. So we are going to be looking to sell the, real quickly to go back, because I have this already up, this is the volume and open interest. You can see Facebook is $116 stock, has 3 cent wide, 1 cent wide, and you can usually, if you come in Facebook and offer 68s in this market, you probably be able to get them a lot of time. Binary event is an event that is known to the market, and it is a market moving event. So you know, an FOMC is a binary event. Earnings call is a binary event. So those are things that there's a lot of unknown wrapped around that event. We know there's something going to happen, and that usually increases volatility because there's increasing uncertainty at a specific point in time. So that's what a binary event is generally construed as. You know, the election could be considered a binary event. There's something that's going to happen on a specific date. We just don't know what the outcome of that is yet. Okay, so you know, Facebook being over $100 stock has, you know, penny wide bid ask. The reason why we want that is because we don't want to have to give up a lot of edge on something like, let's say, you know, I'm just going to throw this out real quick. You know, this is a $6 stock, and it's got 30 cents wide. I mean, you are going to, you know, try and get out of this when you're going to be selling it for 30 cents, and then you're probably going to be, even after a lot of time passes, paying up to get out if you want it. So that's why we stay away from those and do ones with a lot of volume and open interest. And the other thing is, another thing is not having the 70s, but, you know, the further out you go, now it's 50 cents wide. So that's a lot of money, you know, to get in and to get out both ways. You're just going to give up all your money in that, all your profits by trying to get it in and out. How do you fix a long call trade that is losing money on EDZ? Do you calendar calls work for this? You know, if you have long calls and they're not working for you, what I would do is probably, in a sense, sell calls against it. It wouldn't necessarily calendarize it, but I would probably look to sell some calls against it just to lower my basis on that. Curtis, I'm going to take a second to 12/16. I'd have to look over that trade. It doesn't look like a calendar spread from first look, but I'll let you know. And this might answer your own question while we're doing this. So with Facebook, we're bullish. And what we want to do is go to the gamma delta. So that was this is a great example of a high volume and open interest. But, you know, $100 stock, or right around $100 stock, I don't want it to be any wider than, you know, 10 cents. I think Honeywell is one that will be just inside of it. So, you know, that would be right there on the cusp of being outside of my parameters. So back to Facebook again. So we're going to be looking at trying to finance some of this long call that we're buying 70 days out. So, simple enough. And ultimately we want this market to go up because the deltas right here, as you can see, for the same strike. Oh, am I not doing the same strike there? Yeah, I am. 34 delta means for every dollar Facebook goes up in value, so this could go in the money, all right? For every dollar that Facebook goes up in value, the underlying, so when this goes from 116.62 to 117.62, this premium is going to increase by 34 cents, which is going to hurt us. But on the flip side, this premium is going to go up by 43 cents, which is going to offset that to the downside. Okay, so ultimately it should increase for a dollar move higher by our overall profit should increase by about 9 cents. Okay, so even though people don't like to see this really go into the money right away, it isn't going to be extremely painful because it should be being offset here. And as you can see, the further out, they're going to affect it even less. So, like if you were really bullish Facebook, then you could sell the 125s, at a 14 delta and do the 125s here. So that would be like a, for every dollar move higher, this would go up by 15 cents. And as you can see, the theta, that's not a very good example of theta because the theta decay should be more up here than it is back there, but for some reason it's not looking that way. So anyway, so we're going to do the at the monies or just out of the money because it's trading at 116, so let's sell the 166s and then buy the 120s and then buy the 120s in the further duration. So that is the way it's going to look. And most likely if you do that, it's defined risk, so you can see the most you're going to lose is that premium you paid. That's going to be your buying power effect also. And it doesn't give you, I don't know why it doesn't give you the max loss, because your max loss is going to be that initial premium you paid. But your max profit is unlimited, which is why it's going to do that. Say not applicable, because it could really go to the top. When to use at the money? I use at the money if I'm slightly bullish on it. As you can see, it's because it's at its historical highs here. The reason why I would pick at the monies for Facebook is I'm bullish on Facebook. I think that they've done a great job on advertising and monetizing Facebook, but to me it looks like it's kind of losing a little steam, so I would want to go slightly at the money in case it corrects a little bit more and then ultimately comes back into line heading into those earnings, because you can see it. Facebook does have a tendency to sell off before but then come back coming into earnings. There's usually a lot of push. People try to get into Facebook before earnings and they push the market higher and then wait for it afterwards, and it usually goes sideways, which is kind of a funny thing with Facebook. I don't know why. I mean, some stocks just do that. Facebook's one of those that everybody loves for the most part. So I would do the at the money because I'm not super bullish. Now, so if you're super bullish then and you think they're going to knock it out of the park in the next month or so, then or they're going to maybe buy Pinterest or something like that, and that should make the stock go really high, then that would be something where you'd buy slightly more out of the money. Would you ever try to leg into the call calendar? No, the reason why I don't try and leg into strategies, especially not, when I was on the floor, it was a lot easier to leg in and out of strategies. I don't do that anymore. And one reason is, and you know, a reason why we did it on the floor is because we were the counterparty and we had to take risks. So in order to, because you're legging into it and trying to, you know, do the market better, I'm looking at it as a spreader that I am going to make you pay for the risk that I'm having to take on. So if you're doing it as a spread, the counterparty may look at that and say, you know what, there's no risk, the risk is the spread, right? And I know what my risk is. If I have to leg into something as a counterparty to what you're doing, then I'm going to make you give up a little bit more edge for making me naked for a certain amount of time. So legging in, the way I always look at it now is legging in, you're going to basically 50% of the time you're going to do it better, 50% of the time you're going to do it worse. But the 50% of the time you do it worse, it's going to be not able, or it's going to eat up all the times that you did it better, because you're going to be doing it for, you know, several nickels worse. And when you're legging yourself, you might save yourself a penny or two here or there. And at the end of the day, the losses of legging it bad are going to outweigh the ones that you did well. So I always put it on as a spread. I have been known to take these off. For instance, you know, if my short call decays down to like a nickel or 10 cents, you know, at that point, that short call can only hurt me in the long run. Like if something happens and it spikes up, right? That's where I will leg out of that strategy. If that short is worth near to nothing. Now remember, when you're legging out of it for, you know, that nickel or a dime, your break even ratchets up higher because by whatever that is. So if you get out at a quarter, your break even all of a sudden goes up by that quarter. Does that make sense? Because you really didn't get the credit you received in the beginning because you're paying to get out of one side. But never leg into a strategy, especially a defined risk strategy, because the counterparty has to take undue risk. You want to take the undue risk, but the counterparty generally doesn't. What was the other question? Can you buy more time than August? Yes, you can buy more time than August. I don't like to pay a lot for options. I'm more of a options premium seller. So in that regard, if you do it, it really becomes a different kind of calendar, or horizontal, I should say. But you could do that. But look, if we go into Facebook and we do those 120 calls, you're paying an extra $1. So if you're going to do that, then yes, you could like roll these out and collect more premium as these decay to buy you more time, and then roll that out through, you know, the great thing about Facebook is there's even a lot of volume and open interest, excuse me, in the weeklies, you know, not a whole lot of open interest there, but there is a lot of participation in there. You can see these are going to be pretty tight, 15-cent wide, which isn't terrible, especially 42 days out on a weekly. So the idea, though, would be that you'd be getting out of these maybe after 20 days, and you could roll it into these. So if you got out, it'd be 15 days. You can see there's a lot of volume and open interest in here, and they aren't super wide. So you can try and roll, if you're doing Facebook, roll this out, collect a little bit more credit, especially if the strategy is against you. Collect more credit. That lowers your break even on it. And sometimes you can even do it, especially with something like Facebook, you might even be able to do it where you have that long call on for free. Does that make sense? Because for instance, if we sold this for $1.69 and, you know, there was, with 20 days went by, 20 20 days went by and it was out of the money, you'd be able to buy these back for 68 cents, let's say, just as an example off the top of my head, sell it for a dollar. So, you collect about another 30 cents. That lowers your break even by 30 cents. And then you could lower it again by rolling it out again and, as time goes by. So you can continue to keep doing that. Okay, so that's something you can do as well, especially with the ones that have high open interest and volume, like Facebook. Some of the other ones don't even have weeklies and don't even have the August. They just go for the quarterlies. So let me close up some of these so it's not as confusing. Okay, so great question. Yes, because you go into the money with this short option. Elroy's asking, what about being assigned if it goes into the money? Well, if it does, it's a defined risk strategy. You would just elect to assign this person on that when they offset. So that's why there is no, you have limited risk on that. Does that make sense? If somebody does, and somebody can elect to assign you for silly reasons. I've been assigned on trades where I was like, really, the cost of assigning me and everything else, how is it even worth it for you? But, you can still do it. Okay. All right. So moving on. So anybody else have any other examples? So Facebook's a really good one. I like Facebook, so I'm going to write that one down. I don't know why I didn't look at it, because it meets all the parameters, right? Oh, you know why I didn't? Because see that this is what I was talking about with the big difference. You got 6 percentage points ish, right around there, 6.5. So what that's saying is the one that I'm actually having to buy, I'm paying more for because of the volatility. Because volatility is so much more pumped up in Facebook, it's pumping up the premium that I am buying. We are hoping that this is going to go up because we're going into that earnings, or the binary event, but that's not always the case, as we saw. I think it was on this one. There was one example where we were looking at where it actually went down from the time that before the earnings. So that would be the last thing we would want, is this just to be a boring market, and that volatility comes out rather quickly in the next week or so, and that would hurt us on this one. So that's, if I really liked it, then I might bend that rule, but I would just put it maybe on a short list, like put it on your piece of paper. Okay, Facebook I like for this strategy because it's got low implied volatility. I'm bullish on the underlying. It's got tight bid ask. It meets almost all of them, but in a perfect world, we'd want these to be relatively close. So in that, yes, it is an earnings. And you know how you can tell it is landing on the earnings is because, but there's still some cases where they'll be a little tighter. You can tell when the earnings come in because you can just look at this volatility. Look, it ramps up 30 and then it immediately drops. So that tells you that there's an earnings in there, because the next month it drops off. That makes sense? Oh, you said that when are the earnings? They have July 27th earnings. This is looking like it's in August. All right. So I'll throw out because we're running close to time. So I was looking at Pfizer. See, Pfizer has pretty good markets. I mean, it's, not a lot of traders talk about Pfizer. It has a tendency to, it did have a bad run there for a while, but they always make money. I mean, they are always beating earnings, it seems like. And I like Pfizer as a company. I think the drug companies are doing pretty well these days. They just had earnings, beat again. So they could easily trade in this nice little trend heading into the next earnings. So if we look at this, 17 to 19, that's, this has the earnings in it, but it's pretty tight, 2 percentage points. That means that this isn't pumped up a whole lot in relation to this. So in that regard, we would, sell and there's a lot of open interest and volume in all of these, as you can see. So we'd want to sell the 36s and then or the 36 calls in the July, and then buy the August 36 calls. Some people like to go further out first. I don't know if it really makes that much of a difference. We're only paying 28 cents. The great thing about this is what I talked about before is Pfizer has open interest in all of these here. So there is a likelihood that we would be able to roll this out and end up having this long call on for free, which I suggest you guys play around with that and give that a shot sometime, especially if you are not profitable right away on this trade. Like it goes down and it's trading maybe 30 or something like that. You can probably roll it out for, well, maybe not 30, but 33 or something like that. You might be able to get another 10 cents as you're rolling out. Okay, so that's how we would play this. And then we expect that the volatility is going to expand going forward. Because we got the June, we got the August with the binary event in it relatively early in that. So, that gives us a lot of time to be right and hopefully start to see the volatility ramp up heading into that binary event. All right, so another one would be I looked at was ADM. And some people don't like Archer Daniels right now, but they've had a nice run. As you can see, it's done a nice steady rally, pullback. This is what I love to see for this type of strategy, because look, we've just made that peak up, and yeah, it does look like it's going to come off a little bit, but as long as it comes down maybe right to here in this next month and then starts rallying up, those calls will decay worthless, and then we get another pop up. That's kind of the idea behind this. I like to see it just trend like that and trying to get it at the top, not necessarily picking tops, or anything like that, but something that is in a nice trend moving higher, following this nice 45-degree run, and you get that where you can get a little bit of come down, so that I'm long-term bearish, short-term bearish, long-term bullish in ADM. So that would fit something for me selling the at the monies, because I'm short-term bearish. It looks like it's going to at least have a correction and then continue to the upside. And they were getting beat up heading into the season basically because of low grain prices and everything else, but grain prices have been pushing higher, so they could start having better profits than people were expecting. Anyway, so go in, we sell that one, and buy the 44s longer duration. So we've got pretty tight, as you can see here, it's 2.5 or 2.33% difference. That's pretty close. That means that there isn't a lot more volatility pumped into these as opposed to these. So they're pretty balanced in that regard. So you'll be able to get it a little bit cheaper in theory, when you're paying that debit. You're not paying a lot for volatility, and therefore you get that volatility expand in that back month. That really helps you out. Does that make sense to everybody? Why I'm, it doesn't always happen, and don't get me wrong, that's not, but you're increasing your probabilities if these are tighter, and that the further duration is going to expand, and the further duration will then expand faster. What happens if at wave, middle, or bottom? Usually the market wants to come back down and test these highs, but this right here to me would act as a pretty major support. As you can see over here, it acted as support, acted as resistance coming back up. It should definitely act as support coming back down. So I would think that maybe Archer Daniels would want to come back down, test that, and hopefully bounce off and resume its rally. I don't know if that's what you're asking about, Sophie. I could draw trend lines on this and see that it's going to want to, you can see that it's in a pretty good trending area. So if the price drops and volatility increases, would you still make money with volatility increase? Great question, Trevor, and it is possible because the volatility is going to, I wouldn't say you're going to make money, but you will not see the losses happen as fast because even calls will feel volatility. The puts will feel them more because puts are usually a fear indicator for that matter. But sometimes, you can get a pullback and volatility around the markets in general will pump up those further duration ones, and it may not experience as much of a loss. But remember, your loss is only that premium you paid at initiation. You can't lose any more than that because you're the options buyer if it goes down. So we would only lose 60 cents on this. That makes sense? Not a good idea to buy at support. For this one, I really wouldn't want to, and I don't know if you're talking about legging into it or not, but I wouldn't want to sell this necessarily at this support just because, I'm going to have to work for it as if this rebounds. I would rather sell the call and watch that front month expire, even though I'm going to be losing money in that long call in the further duration. Eventually I'm looking at it to go higher. Does it make sense to okay, so Dora's asking, does it make sense to put on both a call at the money and a put at the money? Excuse me, if you are going to be doing something like that, you're going to be buying either the call and you're going to be shorting the put, and that, creates a synthetic stock, basically. Sorry, I have a tickle in my throat. Give me 1 second. Oh, you guys are there? All right, sorry, I had to take a drink real quick because I had a tickle in my throat. So that would create the synthetic option long, if you will. And I don't know that I would even calendarize that. I'd have to think about that. But you'd be buying one and selling the other, because if you're selling the call and buying the put, I don't know that I would do that on a calendarized. Could you use a put for protection? If so, when would you buy that put? Well, I don't think I would buy a put because that, again, increases your break-even level on this strategy. You know, the most we can lose is 59 cents, right? So if I'm buying another put because I think I'm wrong, well, what happens if it rebounds again? You know, then I bought that put, I've increased my break-even. You know, something like this, Trevor, I think I would just let it ride out. I'm either going to lose that, look at it like I'm going to lose that 59 cents. And if you're worried about losing 59 cents, make sure you're trading smaller, because that's the biggest mistake of any new trader, is they think that this is going to be right, and at the end of the day, you might be wrong. So no matter how sure you are, you know, you shouldn't allocate any more than, you know, 5% really to any one particular underlying and or strategy for that matter, because, you know, the last thing you want to do is be really sure and put in 50% of your value into one trade and it goes bad and you've lost it. So no matter how sure you guys are about any particular strategy, underlying or whatever, don't ever go out there and, you know, go all in on a 5-6 offsuit before you see the turn on Texas Hold'em. Okay, just doesn't make sense. Even though you know I'm right on this one, I'm gonna get it. Probably not. So just make sure you keep your sizes small and manage those winners quickly and reallocate to another high probability strategy. Okay, does that answer your question? So don't go out, throw bad money at bad money is really what it goes after. You know, if we're losing on this, we have a losing position. We know what our loss is going to be, and then go and throw by buying another option. You know, that to me is throwing bad money at bad money. So don't ever do that either. If it's a losing thing, there's different ways to manage that, but I don't think that would be the way to do it. The way to do it in this particular instance would probably be, if it was a losing position, to roll some, sell some more calls through the weeklies and lower that overall cost basis and maybe get that long call on for free would be the way that I would play it. I wouldn't buy anything more. Okay, so so Pfizer, ADM, oh, and Halliburton was another one that I was looking at that had pretty close relation. And Halliburton, you know, has just made this big, after this big rally, it's come off. It looks like it's going to want to come off, you know, maybe test this area. I don't know. So upon looking at that, I would go here and look at that one percentage point difference. I think they even skip no, they got earnings in there. That's really pretty tight for the volatility, so that's even better because the earnings are going to land in here. So that makes these pay for more of these at the end of the day. Yes, so ER is asking, keep selling premium to pay off the long position, right? Yes. We would want to, you know, Halliburton has tight bid ask, $40 stock. You know, they're going to have open interest in these. They do get a little wider, but the closer to expiration, you'll see they get pretty decent markets usually. 5 cent wide is usually about what you're going to see in those. You know, 3 cents on the monthlies, and then the weeklies you'll see about 5 cents wide, generally speaking. So yeah, so what we would want to do is just keep rolling our short calls. So we're starting out at 45 calls. We would want to try and So we're going to buy that one. So we're paying 76 cents. You know, if this is a losing position, we're just going to kind of roll these calls out in time and try and collect, you know, another quarter, another 30 cents, something along those lines, and continue to lower this rather than, if it's a losing position, buy a put or something like that. You know, keep the strategy the same. You're just rolling it out and lowering your cost basis and lowering your break even and keeping the dream alive. So those are the three that I found that worked the best. This one's, you know, right now with low implied volatility, as you can see over here on the side, this is the column with the low implied volatility there. Almost everything has low implied volatility, and with this particular one, I'm looking for something that has implied volatility percent below 30. And more importantly, these are, I got my weeklies open, that these are relatively close, somewhere inside of like 5 percentage points. You know, it's sometimes more difficult, but right now we're leaving earnings season and volatility is at really low levels. So you can find a lot of opportunities with this strategy. You can almost just throw a dart at the board and find one. So we start this, Mark's asking, selling weeklies or the near month. So I would start it out right now, 35 days, because I'm going to see the best theta decay in this right now. That's going to decay these rather quickly. And then I would roll it out to the weeklies at the same strike. I'm not going to get inverted. I'm not going to go and start selling, selling calls below my long call. I'm going to at least sell the call at the same strike. And if I can't get anything but, you know, it's not going to be worth it if you're only going to collect 3 cents for it or something like that, right? You're going to want to at least collect 15 plus cents for that roll, for the roll. Okay, that means, you know, you might buy one back for a quarter, sell the other one back for 40 cents. You're collected another 15 cents, which lowers this overall debit paid by 15 cents. Does that make sense? You know, you are increasing your time horizon going out also, so it's kind of dependent on how bullish you are. If your assumption has changed all of a sudden and all of a sudden you're not really so bullish this anymore, then yeah, continue to roll that out too also. But if you are just like, okay, this is just a little market correction, I'm still really bullish this, all right, just let it ride. Don't mess with it too much, because you know, at the end of the day, if it really spikes up like you had planned and that front month rolled off and you collected the full credit for it, then you'll be better off for that. All right, well, that's about all I got. Are there any other last minute questions we have? I think I answered everybody's. They were all great ones. Let me just make sure I answered all of yours, Trevor, didn't I? I think I answered all of yours, Trevor, right? It's just rolled off. I didn't get the recording from the last session. Mesa, hopefully somebody will reach out to you in the answers box if somebody at home base does. How would you structure a calendar with a bearish outlook? Great question, Pete. We're going to be doing that next week, though. We're going to be doing it on the put calendars next week, so you can stay tuned for that or go to Pro Trader Strategies. I'll have to talk to somebody about the not getting the what happened there, because I'm pretty sure I sent it in. Could have been my fault too. Can you repeat the rules? Well, I don't have enough time to repeat all of them, but the idea is, you know, we want this volatility to be very close in relation to this volatility. See, it's 31.21, this one's 32.58. We want that to be inside of 5%. So that's, what is that, 137 something, or 1%, 1.37%. The other thing is if I am near-term bearish, like I see a market correction happening, kind of like what is in Halliburton. It's a little drastic in Halliburton, but if I can see this continue to want to come down before it resumes its rally, then I'm going to be selling the at the money. If I think that, you know, Halliburton's had this move down and is then going to want to rally, then I'm going to probably be selling this slightly out of the money. Maybe you're going to be doing maybe $1 out, and some of them trade in $5 increments, so you'd want to do the next, maybe the $5 out from there. So it's kind of that whole at the money and out of the money is really how bullish you are. The other thing is, make sure we have a lot of volume and open interest, especially in the monthly cycles where we're doing this. Then the other thing is volume and open interest. We want that to be tight. We want to sell at the money depending on that. Am I missing any right off the hand? But in a nutshell, that's really what we're looking for. And cover for small profits. Don't try and be a hero with that. Do you get less credit using vertical spreads? You don't really get credit unless you're talking about the rolls. You are going to get less. This looks like it could be more, but you are going to get less credit for those rolling out. How low should current IV percent be? Good question, Larry. Anything below 30 is where I'm kind of looking for this. Right now, you can pick just about anything. I have a lot of the really low implied volatility ones. I'd like to stay away from like the Googles with this one, because it's going to pop around even though it has a super low implied volatility percent. Google has big moves, and I don't like to see that in this type of strategy. But, you know, you can go as low as you want, but I like to try and stay below 30% because I don't want to see volatility to go down on me during the duration of this strategy. So if you can pick the lower the better, because ultimately if it's really low, probabilities are that it's going to go up, right? If it's kind of mid, probabilities are that it could go really either way, right? It could expand, but you know, if it doesn't, then it's going to hurt. So that's the way I would kind of play that. All right, well, that about wraps it up, you guys. We're doing this offer for you guys that joined this right now, which comes with a lot of stuff. You know, you basically get all of these, how you set up your options screen. You also get, let me slide this over because I can scroll then. You get delta and how it measures. I don't know what happened there, but basically it went to something else when I refreshed it. But this link is in the chat box, so when you click on the chat box there, you can get that sent to you. How to measure and use theta decay. You're getting all of these videos. So, and we're setting up all kinds of different packages where you can go through, and they're all pretty related. So check those out. You can hit that link right there inside there. And that's pretty much, you know, using market profile, which is something that I use all day long, every day. And you may have even seen it. It's the blue stuff on the side of those expansions on my charts, because that really is the psychology of the market in my eyes. You know, candlesticks tell a lot whether the market's turning bullish or bearish, but this gives you insight as to where the participants are putting their money, where their mouth is. Which video setting up the option screen like the market profile does, and there's one on there, basically Delta and all of those. So they're all in there. All right, so like I said, that was in the chat box, the link for that. That's also this link here, but you don't have to write it all down. You can just go to the chat box and hit on it. And later webinars, we're going to be drilling down on different options component, like Peter, we talked about. We're going to be doing one in the bearish outlook for trades. That's going to be next week, and how to trade options, where I find particular strategies appropriate and the underlyings that fit with that. So stay tuned for that. We also, if you joined up, I do daily market commentaries where I talk about the trades I'm doing, you know, when I find them appropriate, when I'm managing those, and go through basically all the steps that I kind of talk about in the videos. Also, if you guys have an idea of a particular webinar you want us to do something on, or to cover a particular strategy that maybe I haven't touched on, please reach out to us and talk to us about that. Also, if you guys are signed up for this, also, I am more than willing to talk to you about trades that have gone against you, things that aren't working for you, and I can tell you what I would do. You know, it's up to you guys again to pull the trigger, I guess, for lack of a better word. But I can tell you what my rules are and how I would handle the situation. So please reach out to me, because I don't want to see you guys lose money when you guys can be lowering cost basis on different things and stuff like that. So I want to thank you guys all. If you have any questions, you can contact us at 310-598-6677, or you can email us at trading@protraderstrategies.com. All right. These are not CDs. They really make it look like that. They send you the videos, I think, or they send them to you like the PDF like file. All right. I appreciate it. You guys have a great weekend. And if you can't take that, take it easy.